because David and Paul are not just some of the luminaries in the financial world, renowned private equity players who respectively founded Carlyle or co-founded Carlyle and Elliott, but they're also, I must say, some of the savviest commentators or biggest thinkers on financial markets and the economy that I've spoken to in recent years. Now, don't get lulled into me being nice to you. It's not necessarily going to continue. But I do very much appreciate the thoughts you've shared over the years about where the markets and economy is going. And the fact that it is standing room only right now on a beautiful sunny afternoon in Aspen indicates that I think a lot of us have got big questions about where the economy and the financial markets are going, because the story of the last year has been something of a surprise to many commentators, myself included. Most people were not expecting the markets to rally dramatically after Donald Trump's election victory. Most people were not expecting growth to accelerate. The president in the last few days has been tweeting triumph with the current pace of growth and essentially saying 4-5% annualized growth is something that no one thought could ever happen, but it has happened. So I guess the question really is this sustainable? Is it a mirage? And if it's not sustainable, just how worried are you going forward? So let me start maybe with you, David.
All right.
Do you believe that this current growth boom is for real?
Well, first, I want to thank everybody for coming. This is the biggest crowd I've spoken in front of since my bar mitzvah. So some of you might have been at my bar mitzvah. I don't know. So obviously, the question about whether it's too good and things can't keep going is really a question I ask myself all the time, because when you're Jewish, you always think something bad's about to happen, right? And I've been saying this can't keep going on for the last 5 years, and every year I've been wrong. Eventually, I will be right. I don't think it can go on forever. Rubenstein, the former head of the Council of Economic Advisors under President Nixon, once said, if something can't keep going on forever, it won't. So we're now in an unbelievable growth cycle. We have a recession on average every 7 years in the United States since World War II. We are now in the second longest growth cycle since World War II, about 110 months. At some point, it will slow down. I don't know exactly when. Nobody can predict exactly when. Maybe Paul can predict exactly when. He'll tell you in a moment when it's going to slow down. I just think that no one really knows for certain what will cause the slowdown. My view is that probably one of 4 things could cause the slowdown. I don't know which one of the 4. One, eventually we recognize we're borrowing more than we can really afford. We now have an annual deficit in our federal government of about this year about $900 billion, $1.2 trillion next year. We've added $2.3 trillion because of the tax cuts over 10 years, $1.2 trillion over 10 years because of the spending cap increases. We're probably going to have in 10 years not $21 trillion of debt, but $35 trillion of debt, and that is probably unsustainable. And so at some point, the financial markets will say, we can't keep borrowing at this level. So that's one possibility. A second possibility is the emerging markets go into a big tailspin for this reason. As the dollar strengthens, and it's strengthened a fair bit over the last few months against emerging market currencies, the emerging markets have about $5 trillion of corporate debt that has been borrowed in dollars, but they're earning their money in local currencies. So as the dollar rises, the ability of the local companies in these emerging markets to pay off that debt is not probably likely, and therefore at some point you could have an emerging market debt crisis. A third possibility is that we basically go into some kind of tariff war. I don't really think that will happen. I think we're doing a lot of skirmishing, but tariffs is another word for tax increases. And if we have tax increases, it would undercut the tax cuts that we've had, which are stimulating the economy a bit. So if we went into a sustained tariff war of some type, that could slow down the economy. And the last is some geopolitical event we cannot anticipate. We don't know what geopolitical event might happen that we can't anticipate. Is Russia going to go into the Ukraine? Is Iran going to invade somebody? Is Saudi Arabia going to invade somebody? Is China going to invade somebody? Is the United States going to invade somebody? Maybe a greater prospect. So I don't really know, but one of these things is probably going to cause the markets at some point to say, you know, I think I'll take some of my chips off the table. And if that happens, I think you'll see a slowdown. I don't think it'll be the great recession we had, but some slowdown, and that's not actually a bad thing for economies to occasionally slow down a bit. So I don't know exactly when it'll slow down. It will slow down at some point. I think this year it looks pretty unlikely that we'll have a slowdown because the economy is in reasonably good shape by borrowing so much money. We're probably going to have growth of around 3% this year, maybe even slightly higher than that. And so I think if there's a slowdown or recession, probably not in the immediate future.
Well, thank you, David. Judging by your press clippings, you become a bit gloomier because last week you said there were 3 factors to look for.
That's right.
Now there are 4.
I said 3 economics. I added the geopolitical one because I never know when a geopolitical factor will come along. The geopolitical factors are black swans. You can't predict what a government's going to do. Look, we didn't predict the last recession. Remember, no one really predicted the last recession would come about because of the subprime mortgage crisis. Nobody knew when a couple mortgages in Southern California and Arizona and Texas couldn't be financed or couldn't be sustained, that the whole economy would collapse and the global economy would collapse. So you just don't know what will happen. I just think these are likelihoods. Most likely when the recession does occur, when it does occur, it will be for some reason that maybe some possibility that thing that I didn't mention. But these are the ones I think are most likely.
Okay, so 4 things to worry about. Paul, do you want to cheer us up?
No, that costs extra.
Okay. Well, this is a high-paying crowd.
As does prediction. But a few comments. I think David put his fingers on many of the contextual elements of in thinking about today's economy, global economy. But a few additional elements. One of the things that has been a kind of a mantra is that the developed world is in the midst of and will continue to be in the midst of for a very long time, secular stagnation. I don't believe in the theory. I don't believe in the reality of secular stagnation, whatever that means. And I believe...
Is Larry Summers here? No. Okay.
And I believe that policy, good policy and bad policy, are responsible for the important ebbs and flows in growth prospects. And I think that in the developed world, what's looked like secular stagnation to some people is the result of bad policy. And I'm talking about tax policy, regulatory policy, and interestingly, post the crash, the 07-08 crack, I believe there's been very little in the way of structurally useful and productive pro-growth policy. I think what has taken on the major burden for holding up the global developed economy, which sort of is holding up the global economy, is monetary policy around the globe. And so in the absence of structural reform, the most extreme monetary policy in history, 0% interest rates, negative interest rates, $20 trillion of quantitative easing. Some people, like myself, think it's the effective equivalent of money printing. Others don't. But there's $20 trillion, just shy of $20 trillion on the balance sheet of the major developed world central banks. And what that's done is held up asset prices, bid up asset prices. And so asset price appreciation, but not wage inflation around the developed world, has been the growth, holding up the economy and the growth driver. And what I think after 9 years of this policy, one country has migrated its policy, and that's the United States, towards more what I regard as pro-growth orientation, regulation, and taxes. But basically, I feel that the global economy has become way more indebted than it was in 2008, and I think risks are building. One place that I think I disagree with David's assessment is that I believe that the functioning of the economy, economic growth, which may appear to act upon markets and to cause markets to change directions, I think it's the opposite. I think if there's a slowdown or a recession, which global policymakers are absolutely determined not to allow and actually believe will not and cannot happen. Janet Yellen was quoted amazingly as saying that there'll never be another financial crisis in our lifetimes. But I think one of the things that 07, 08 suggested, I wouldn't say proved, is that markets can lead and be the causation for significant changes in economic performance.
Well,
let me just mention that. You mentioned the word recession. I got to be careful about this. I don't want to be quoted using that word. My former boss, Stuart Eisenstadt, where is he? Stuart. Stuart's here. Stuart was my boss in the White House in the Carter years when we managed to get inflation a little bit higher than it's been lately. And
that's quite a low bar.
Our inflation advisor was Fred Kahn, a distinguished economist from Cornell. And he said one time in a briefing room that we thought we were going to have a recession. Well, President Carter called him in and said, look, I'm running for re-election. Don't use the R word because it scares people. So the next time Fred said, well, look, I'm an honest guy. I can't lie. So he started using the word banana. And because he would say, we might be heading for a banana, because the reporters wouldn't want to put a headline saying Carter's inflation advisor thinks we're heading into banana. And so I have the same thing. I don't like to use the R word because it scares people. And reporters often, want to say, all right, Singer or Rubenstein thinks it's a recession coming, so forth. I don't really think that's a word that I'm going to be associated with right now.
Okay, well, in that case,
banana.
If you're feeling a bit shy about that R word, I'd hate to make you blush by using the R word by accident. Let's turn to somebody else who's actually been a bit more direct recently. Quite remarkable. How many of you in the room read the Bank for International Settlements annual report? It's not bedside reading, I agree, but it's absolutely...
Excerpts.
You do. It is one of, if you want to understand what's happening in the financial system in one go, it's one of the most interesting documents out there. It's a kind of snapshot of the global economy, the financial system, from the central banker's central banking club, which sounds fantastically boring, and yes, it is a bit boring, based in Basel, Switzerland, but they just came out with a report that's really pretty chilling when you look at the level of imbalances in the financial system. And Augustin Carstens, ahead of it, wrote a column for us which says this: our analysis indicates that the risks ahead are material. Material in central banker speak means run. A decade of unusually low interest rates and large-scale central bank asset purchases may have left many market participants unprepared and have contributed to a legacy of overblown balance sheets. Financial conditions are easier than before the last financial crisis, i.e. there's even more of a boom now, when many investors, households, corporations, and sovereigns were caught out in the rain with no umbrella. Does that make you nervous, David?
Well, what they're really saying is we've been borrowing too much money. Now, let me put it in context. Before the Great Recession, the United States had 250% of GDP in debt. 60% of that was corporate debt and personal debt. 40% was government debt. 10 years later, it's now the reverse. We have 250% of our GDP in debt, but it's 60% government debt and 40% personal and corporate. Now, what's that mean? Well, when you have corporate and personal debt, they can default, and that can hurt the economy, as we learned. Government is not likely to default, but it's just going to have to print more money, which will produce more inflation, and ultimately what it'll mean is we're going to cut benefits, because ultimately the government will have to say we cannot afford Medicare, Medicaid, and Social Security at the levels that we currently have. Take Social Security as a good example. We pretend that the Social Security fund is not in trouble right now for some reasons. But the truth is, there is no Social Security trust fund. There's no lockbox, as I think everybody knows. It's pay as you go. Whatever you're paying in Social Security is going out to somebody the next week. So what we have in Social Security now is a system that, when it was started in 1933, we had roughly 34 workers for every person collecting benefits. And the retirement age was 65, and the average life expectancy was 65. Now we have roughly 3 workers for every person collecting benefits, and the average life expectancy is closer to 85. So it's not sustainable. We'll have to change that. And President Trump in his campaign said, I'm not going to touch Social Security, Medicare, Medicaid. But if you don't touch that, you have nothing left in the budget to touch unless you're going to cut defense spending. There's nothing left. So that's what you're going to have to do. And eventually, when the government debt is at the point where we realize it's not sustainable, those are the things that are going to have to get cut.
I'd like to build a little bit on the points that David just made. The 250% that he spoke about is not by any means the end of the story. And when you add not only Social Security, but Medicare and Medicaid promises already made, which in my view are the effective equivalent of debt, because all attempts to rein them in and make them more rational have failed politically. You get numbers that are pretty shocking. You get something like 500% in the United States, 800% in Japan. China's ratios pointed to the moon, mostly in regular debt, not entitlement debt, because they don't think much of entitlements over there. This printing of money is interesting because one of the things that is most dangerous for the global economy and markets, which we haven't turned to focus on yet, but they're sort of linked. One of the things that strikes me is that the global central bankers, who demonstrably did not understand the risks that were building in 2007, 2008. The reason I can say that with assurance is that the minutes and transcripts of the Fed meetings in the entire period, 2006, 7, 8, and before and since, they're public. You can get them. You can read them. You can see what they were saying about risk in 2006, 7, and 8. It's not an overstatement to call them clueless. And so they moved into this money, let's call it money printing just for fun, and for accuracy in my view. But they moved into this money printing thing, which did hold up the economy and certainly ginned up the prices of bonds and equities. But it did not generate a lot of consumer price inflation. So in my view, the way I think about it is they got away with murder, meaning debasing currency is the easiest thing in the world in global history in the last 5,000 years. What's hard is to preserve the purchasing power of fiat money, money not backed by specie, gold and silver. And so what worries me in the next anything, call it a banana, call it a pomegranate, if Stu Resnick is in the room. But the next anything will cause or could cause them to think, because they haven't been punished by markets for this extreme monetary policy, that all they need to do is double down. So the $20 trillion on their balance sheet turns into some much larger number, and at some point, there's a risk, I'm not going to say an inevitability, but there's a risk that the next round, back to 0% rates in the United States, further negative in Japan and Europe, that the next round causes some kind of flight from one or more currencies or from fixed income.
Well, one of the advantages the United States had in being able to develop this policy is that we're the only global currency. So we're the only reserve currency. The euro has turned out not to be a reserve currency of strength and therefore not a serious reserve currency. Obviously, the pound is no longer a reserve currency, and the RMB is not appropriate for a reserve currency. So we have the only thing that anybody really has to buy if they've got to buy an equivalent of something they know is going to be paid back. It's like, for example, you've read the Chinese might be thinking of taking their $1.1 trillion and not buying dollars because they're mad at us. That isn't realistic because the Chinese have to buy it. There's no other place they can park that money. The same with the Japanese who have about $1 trillion as well. There's no other place to park the money. But the result is that we can sell these dollars anytime we want, and we might pay slightly higher interest rates. At some point, it'll be more expensive than today. But right now, as long as we have the only reserve currency, we've been able to get away for this for a long time. At some point, we'll pay the price. I don't know exactly when that will be. But I'm just curious, how many people here think the economy is going down next year? Any people?
Who expects a recession?
How many people think it's going to get better next year? Okay, and how many people think the economy is being well managed in Washington? Wow, not that many. Okay, how many people have confidence that our government officials will figure it out eventually? Oh, wow. Okay, well, that's actually happened. I live in Washington, and people in Washington just keep passing these bills, increasing spending, because there's no pushback from the markets, honestly. The markets in New York and around the world, they haven't been basically saying we're not going to tolerate this additional amount of debt, and therefore the people in Washington will keep passing these bills and spending more. Not until we have a situation where the markets go down precipitously and stay down for a while, and there's real panic in the streets, will you see any change in Washington, D.C.? We're not going to do anything, in my view, not we, but the government isn't going to do anything until there's something serious. And the other problem I didn't address earlier is one that we all like, but we kind of recognize the problem. when 1900, the average life expectancy in the United States was 49. In 1933, as I mentioned, it rose to 65. Today, it's about 85 or so, depending on demographics and ethnicity and so forth. We are 10,000 baby boomers are turning 65 every day. We have 13.5% of our population that is 65 or older. Japan is actually worse; it's 23.5%. But we just can't sustain these the entitlement programs we have for all the promises we made with the amount of money we're earning right now and the debt and the revenues we're taking in. We take in about $3.1 trillion a year in the federal government from various taxes, and we spend about $4.1 trillion. So we're about $1 trillion under taxed, really, relatively speaking. Nobody wants to have a tax increase. So we're either going to have to cut the benefits or increase taxes or get growth up. And getting growth up is very difficult now because we have a large percentage of population not working. We usually have 66% of the workforce, adults, females, and males in the workforce. Now we have about 62%. People are retiring and not working, and they're living longer. So we're going to something's going to have to give. And I don't know when it's going to happen, but it's going to happen at some point.
Can we talk about trade for?
We certainly can talk about trade. Is trade going to be what sparks something giving?
My view is that the impulse that is at work in this current trade war, trade spat, whatever, has a core of rationality to it. There are dangers, and I'll talk about that in a minute. But over a period of time, some of the major trade relationships of the United States have become asymmetrical. Europe and America is asymmetrical only in military spending and required military spending. The rest of it sort of balances out, not in every product or industry. But certainly the relationship between China and the rest of the world, China and the US, has become imbalanced. China has done a remarkable job in providing hundreds of millions of jobs, and not just jobs, but lifting people out of poverty to the working class, the middle class, over a long period of time. It's no longer an emerging economy, and in some of the trade relationships, it's being treated like an emerging economy. And so there's a tremendous imbalance between the United States and China. It's not just tariffs, it's not just taxes, it's all kinds of stuff, and it's not just appropriating or misappropriating technology. There's a lot of support and supportive industries, approving of mergers only with joint ventures where the Western company has to give up its technology. So having said that, Trump is the first president in a long time, I don't remember 5 presidents ago, but who has actually addressed this. And one can criticize, I don't want to nitpick, but he is addressing this. The danger, of course, somewhere between action, counteraction, higher action, there can be significant impacts on global trade. So it has to be handled with finesse. But if you're looking for what can go wrong, markets at the moment do not believe that this will resolve in an all-out 1930s style competitive devaluation and massive competitive tariffs situation.
You think it's being handled with finesse right now?
It depends how you feel about certain negotiating styles.
Depends on your definition of finesse, I guess, right?
Well, the great thing about having David on the panel is he spends half his time being an interviewer these days instead of an interviewee.
Anyway, go ahead.
So, no, it's wonderful. I'd just like to circle back to the markets again for the moment and say, which part of the markets do you think are most overheated right now as a result of all of this money swirling around the system? Which parts of the markets would you not touch with a barge pole?
Cryptocurrencies. But it's sad that we're sitting here on June 29th or whatever today is. Just 4 months ago, we could have waxed, really passionate about the craziness. But the $850-ish billion market value of all of the cryptocurrencies is now down to about 2-something. And some of them have actually gone to where the rest of them will go shortly, please don't ask me to define shortly, zero. But there's a major pocket. High-end real estate in the high-end places around the world is in a major bubble. Within 2,000 yards of my office in New York, $150 million apartments, $100 million apartments. Several of the people in this room are living in them.
You may not get invited over for dinner anytime soon, but yeah. What about the equity market? Do you think the equity market's a bubble?
I think a bubble is a strong word, and it should be reserved for things like the dot-com and like cryptocurrencies. I believe the equity markets are stretched and are, my logic is it's not just the valuation, which I think is stretched, although earnings projections have been going up, and on earnings projections, they don't look so stretched. But my logic is that 9 years of quantitative easing and NIRP and ZIRP, negative interest rates and 0% interest rates, policy have had a major impact on stock and bond prices. And as the derivative of movement of quantitative easing and monetary policy has turned to just a little bit above zero expansion by risk standards, that is a turn towards tightening. You don't even need the thing that's supposed to happen next year, which is actually trying to reduce these balance sheets. God forbid these balance sheets are where they are in the middle of with the next recession coming, and central banks trying to double down.
That's kind of what the BIS is saying. The balance sheets have become even more bloated. But David, I'm curious, given your concern about the rising US deficit and the benefits problem and the debt load getting bigger and bigger, would you buy 10-year Treasuries right now?
Well, it depends on what your situation is. I do have lots of Treasuries, because I think you can get paid back. The interest rate is not the most important thing. You want the certainty of getting your money back, and U.S. Treasuries are probably about the best thing you can buy for that purpose. But I think in terms of bubbles, it's hard to know what a bubble is until you're out of a bubble. Then you can say, oh, it was obvious. It was a bubble. And the smartest people in the world have gotten caught in it. For example, Isaac Newton, a brilliant person, maybe one of the smartest people who ever lived, he thought he could make some money on the side, and he started doing investing, and he made some money on something, and then he got out, and it kept going up. And he said, oh, I got out too soon, so he went back in and lost all his money. So the smartest man in the world at the time lost all his money. And I got in trouble for this subject when I made a speech at Harvard Business School. I was trying to explain this to students, and I tried to use a subject matter I thought they would understand. I said, sometimes in sex, maybe there's some things you do maybe you shouldn't have done. And sometimes in investing, maybe there's some things you do you shouldn't have done. And unfortunately, the headline turned out said, Rubenstein says private equity equals sex. And that wasn't what I meant to say, but what I think you don't really know you're in a bubble, honestly, until it's over. A bubble that I think is now clear that exists is one you referred to. Billionaire apartments in New York City, they're see-through buildings now that have a lot of these billionaire apartments. They just were overpriced. I don't think they're going to be filled up for any time soon. Or buying golf courses. I think golf courses, people are playing less and less golf, and I think golf course is probably not a great investment. But the most important thing that I like to tell people about this is this. Don't try to worry about bubbles and so forth. Try to be realistic in your investment returns. Everybody that made money generally made it in area A or area B, and whatever your area of expertise is, it's probably not investing. If it's not investing, don't try to be a genius in investing. You might be a genius in area A, you built a company that's great, but don't try to prove you're a genius in area B. There are very few people who are geniuses in the investment world, and rarely are they people who've made money or are geniuses in something else. So the most important thing about having money is not losing what you have. That's by far the most important. So have very realistic expectations of your rates of return, and then therefore if you want to dabble in something that is more exotic, put a very small amount in, and don't be disappointed if you don't double your money or triple your money overnight, because it's not the money that you're depending on. The worst thing in the world is to lose everything you have, and as the old saying, shirt sleeves to shirt sleeves in 3 generations. So all of you here, no doubt, have made a fair amount of money, or you wouldn't be here, and I suspect, and you want your children to have a fair amount of money. Well, don't try to double or triple your fortune overnight by investing in exotic things like cryptocurrencies. It's not probably going to be a happy ending. Just make sure you don't lose what you have and have very narrow expectations of what you're going to get. You'll probably be very happy.
Paul.
I've got to remember that, David.
Well, let's see, but you're an investment.
Really good.
But you're an investment professional and you're a genius in that area, so you're different. But somebody that builds a widget company is not necessarily an expert in investing.
Okay. I have a couple of things to say which I think could be useful. One thing that could be useful is you should understand that through basically history, certainly the history that I've experienced in 41 years running this fund and read about beyond the 41 years that I've been running the fund, gurus never, ever get the timing, the shape, the intensity, the composition of any financial crisis or even major change in market directions. Neither do policymakers. We know for a fact that central bankers don't. We could see what happened in 2007, 2008. So do not look to even the greatest of experts in media outlets.
Except the Financial Times.
Except the Financial
Do look to the Financial Times.
For guidance as to when, if and when a bear market or a change in the economic climate is coming. Most recessions are recognized in the sort of early, middle, or maybe even the middle of them. The best we can do, in my view, and so what I just said, I think is demonstrable. What I'm about to say is my opinion. I think the best we can do, and I think it is possible to do it, is to understand broadly the context in which the assets you own or could own. What is the context? What kind of people are buying them and owning them? Is it easy to borrow money? Do the prices seem crazily high or crazily low? Crazy high does not mean they can't go a lot higher. In 1998, I got run over. I mean, I run a diversified portfolio. I got run over having waited and waited and waited to short the internet stocks. I got run over in Yahoo and this one and that one. And of course, the people whose careers in the hedge fund industry, whose careers were ended or basically downsized, were the people who in September and October of 2008, with some justification, thought, wow, look at these bargains, and loaded up only to watch this waterfall into early December 2008. So what I believe about today's markets is they are vulnerable. There are a number of potential accelerants on the downside. There are some aspects of today's markets that remind all of us of 1987, short volatility strategies that are, as we say, pro-cyclical, meaning if there's a strategy which attracts demand on the upside, you say, or a technique, you say that's pro-cyclical. If there's a strategy where selling begets selling, leveraged holdings in equities, margin debts at an all-time high, and other things that are the effective equivalent of margin debt. So right. I think that markets are vulnerable. I don't have to think of them as being in a bubble, but I think there's a vulnerability there.
Let me just mention one other area, which is the technology-related stocks. Everybody wants to catch the next Facebook or Google, and it's not that easy to do because there's so many of these companies you don't know which one is going to come forward. When my daughter and her future husband were at Harvard as undergraduates, they said, my future son-in-law said his classmate from Harvard and Phillips Exeter was starting this company, was going to called Facebook, and would I like to invest in it? And I said, look, I looked at these kind of companies before, they're never going to get anywhere. And so that was a mistake. You can't predict which ones are going to make it. But what happened with Facebook is really set off a technology unicorn bubble. And here's what happened. Typically, when you have a technology company, after a couple years, if it's going anywhere, you got some earnings and some nice revenue, you'll take it public because the IPO enables you to get money out for the early investors and liquidity for the founders. But with Facebook, they held off going public so long that a lot of people who wanted to sell, early investors or some of the founders, they were able to get money by people buying their shares in a private market, not the public market. And those people who did so made a great fortune. People were buying Facebook shares at $3 billion, $10 billion, $50 billion, and even higher, and it went public at a much higher price, and now it's worth 300 plus billion. So people said, well, I can invest in these technology companies pre-IPO and still make money. And so now a lot of people are investing in these technology companies, often known as unicorns, that have these high values before they go public. And I just say be wary of them, because some of them just don't have any real prospect of living up to the valuations. Some might, but not all of them. So you have to be very, very careful. I was offered today an investment in a company. I won't mention the name because maybe I'll invest in it, but it does something that I never thought would be a service. Maybe some of you have seen this. It's electric scooters. Anybody seen this? Where, you know, if you walk and you go down to New York or all the major cities, you see these kids, people not my age, going on these electric scooters. Apparently it's a great business. The question is, what's the valuation of it? And you know, if it's offered to you, be wary about the valuation of some of these companies, because people think that all these things are going to keep rising. At some point when there's slowdown, all these technology companies will have much lower valuations.
Right. I'm going to turn to the audience for questions in just a second. I have to ask you, though, if we're talking about bubbles, do you think the private equity world is in a bubble?
I couldn't hear you. What was that?
You've got about $1 trillion of spare firepower sitting there. You have a lot of M&A activity, right, a kind of frenzy going on. You've got some pretty crazy valuations. I mean, you know,
okay,
surely...
let me answer it this way. When I started Carlyle, there were 250 private equity firms in the world, 1987. Today, there are 7,500 private equity firms in the world. So obviously, it's been a growth business. Now, why are there so many people investing in private equity? Well, not to sell private equity so much to this audience, but the truth is the returns over the last 5, 10, 15, 20, 25 years have been fairly consistent and fairly better than almost any other asset class. What's changed, and the reason people are still pouring money in at very high valuations, is that investors have lowered their expectations of rates of return. It used to be the case, if you went into private equity, you wanted a net internal rate of return of 20%. After the exit and everything was done. Now people are saying, give me 13, 14% net internal rate of return, I'm very happy. So people have been able to pay these higher prices because they know the investors are willing to take lower rates of return. That doesn't mean it's necessarily a great thing, but I don't think it's a bubble, because I think the returns are going to be okay. They're just going to be lower than what people used to get.
Paul?
I don't, first of all, David has built a fantastic business, and many of his peers have wonderful businesses and add lots of value to the companies they invest in, as well as their investors. My experience with the periods, there's a lot of cyclicality here, and one of the things that I observe as a market practitioner is that the vintage of private equity deal, because they have successful firms do deal after deal after deal. The vintage is one of the most important determinants of your rate of return. My experience in general, not just private equity, but in all the businesses that I trade, is that the periods of time and the ebbs and flows in which return expectations are marked down can be very dangerous rates of return. I just remember very vividly in my businesses, in 2005 and 6, my traders telling me, you know, investors are satisfied with 6, 7, 8%. You know, what do we can't get the historic 13, 14%. We should go along with the flow. And of course, what that actually meant in practical fact was that financial assets were overpriced. Credit was very, very overpriced. And there was just a lot of room to fall. When Joe Rice was the head of the Williams College Investment Committee, and I was on the committee too, what his criterion was back then, or at least he said it, was 30% IRR. So I don't think the private equity world gets
30% IRR. Well, you have small college endowments that don't have to put out that much money. They can pick and choose the best venture funds and smaller funds that might get not 30% net so much, but higher rates of return. But if you've got to put out tens of billions of dollars, it's hard to get those kind of rates of return. Now, I interviewed you on my TV show, and I think if I remember, you said over the 40 years of your firm, you've gotten a very high net internal rate of return. I thought it was 13.
13.4, 13.
So that's a pretty good rate of return. And my point there is 13% is not 30%, but if you can compound that over 40-some years, that's very unusual. And your business is different than mine because hedge funds tend to come and go in cycles. Very few private equity firms have gone out of business, very few. A lot of hedge funds go out of business because every time there's a down cycle, they can't make their high water mark, they go out of business. So how many
of them don't hedge?
They don't hedge, that's right. Hedge is not what they do. But how many of the hedge funds that when you started your hedge fund, how many are still in business? A limited number, I assume.
A limited number, handful.
Wow. Well, on that thought-provoking note, let's turn to some questions from the audience. We have microphones. We have a question down the front. Please be very brief. We have already talked, sorry. Yeah. Please be very brief, and it would be courteous to identify yourself.
Yeah. Hi, my name is David Lichtinger. I'm from Palo Alto, California. I'm also on the Stanford Institute for Economic Policy Research Advisory Board. So this is for David first. And, David, given central bank policy in the U.S. right now, we have a new head of the Federal Reserve. We're on track to have QT as well as tightening of 525 basis points through the end of 2019. Right. Now, I know you don't like to use the R word, but how could that not cause a recession?
Okay, let me describe.
Great question.
A number of years ago, I hired a guy who was leaving the U.S. government. He was a very nice guy. I brought him into Carlyle. I was at Carlyle for 8 years. I thought he was a very good, very nice guy, private equity person. He left. He said he got tired of private equity. I never thought I'd hear from him again. His name is Jay Powell. He's now the chairman of the Federal Reserve Board. So, you never know what's going to happen in Washington, D.C. He's a very smart guy, and one of the things he's going to do is he does not speak, he's not a PhD in economics, he doesn't speak in Fed speak. So he's actually determined to actually speak in English, and so the average person can understand what his policies are. He has said in English that that is what he intends to do. And the reason I don't think it's a terrible thing is that when you do have the inevitable banana, the Fed should be lowering interest rates. And when they lower, if the interest rates are so low already they can't lower it, they have no tool in their war chest. So I think if you have incremental increases, the market adjusts them, it's one thing. But, for example, when Paul Volcker was chairman of the Federal Reserve under Carter's years, one weekend he increased the Fed funds rate by 200 points in one weekend. Well, that's a big shock to the system. I think the system can tolerate gradual increases when it's known in advance. So I don't think it will necessarily cause a recession because I think it's not still that high in terms of what the interest rates would be, and it's predictable, and markets will be able to adjust to it in advance. That's my view, at least.
Do you believe that, Paul?
It's good that you mentioned Volcker because let's contrast Paul Volcker, the situation he found, and his achievement in raising the policy rate to 20%, I believe, over a couple of years, and not crashing the global economy. There was a double-dip recession, 80, 82, as I recall, but the system was much less leveraged. The system was robust. The 20% interest rates wrung the neck of inflation until it was dead. And it took a while, but the system was robust enough. Nobody can possibly imagine today, including the Fed and Chairman Powell, 7% policy rates, much less 10 or 15 or 20. In fact, you can see exactly how they feel about the fragility of the system by this wild attention to forward guidance and messaging. You can only imagine these people sitting around the table, brainstorming deep into the night before somebody coming up with the word, I've got it, taper, we're going to taper. And of course, a ridiculous concept, a ridiculous word about a coming possible increase of a little bit in interest rates. That word caused 80 basis points of rise in interest rates in, 2 weeks, 2 or 3 weeks. And so the system is obviously thought by policymakers, and I sort of agree, to be pretty fragile and not really able to take higher rates. If the economy does well, and if the major central banks are able to get rates sort of back to normal and get rid of some of this $20 trillion, they may be more prepared for the next crisis.
Okay, we have a question right in the front here and then over there. So, right in the very front row.
Hi, thank you so much for your insight about what's going on. My name is Kalok Day Weingart Ryan. I'm with the Center for Humane Technology. I have a hypothesis that the civic consciousness that was such a big part of my grandfather's generation is no longer as present as it once was, especially with the millennial generation and folks that are building these humongous tech platforms that do a lot of good but may be creating some harms. My question for you is, as leaders in private equity and in the hedge fund space, is civic consciousness a part of your work? When you wake up in the morning, are you considering the consequences of your actions and the impact on humanity over time?
Go for it, Dave.
Okay.
You're asking the man who's sometimes described as one of the most feared activist investors.
In the early 1980s, when Ronald Reagan was President of the United States, there began to be, and Margaret Thatcher was Prime Minister of England, the concept proposed perhaps by Milton Friedman and others was that the most important thing that business people can do is get a good rate of return for their investors. That's the only thing they should worry about. And therefore, the concept of shareholder return was the only consideration. And therefore, private equity people, in reflecting that, basically said, how can I get the highest rate of return? So if it means shutting down plants, moving them offshore, not worrying about the environment, they did that. And Mitt Romney, for example, paid the price of it because when Bain was part of that in the early 80s, many of the things that were brought out when he ran for President of the United States and ran for the Senate were things that that firm did and other firms did in those days. They just weren't sensitized to that. Today, any private equity firm worth its salt has an ESG program where they are very worried about the impact of what they do on the environment, the impact of what they do on social good, very much concerned about diversity and other issues. Are they as good as they should be? No, they're better than they once were. There is another phenomenon in private equity that's taking hold called social impact investing, where you are focused on the impact of what you're doing more than the rate of return. And there are some people that say if you invest in impact investing related companies, you'll actually in the end get a higher rate of return, because if you worry about global warming and invest in companies that are doing something about it, in the end, the markets will come to you and you'll do better off. Whether that's true or not, we don't know. But I'd say I don't wake up in the morning and think that I am ruining the world. My theory is that we are sensitized to the environmental concerns and the kind of things that you're probably referring to, and we publish an ESG annual report. But we also think that we're doing a good service because most of our investors are public pension funds, firemen, policemen, teachers, and so forth. So we think we're actually adding something to good. But most people on the face of the earth don't look themselves in the mirror and say every day, I'm a terrible person, I'm ruining the world. Most people think they're doing something useful, and I guess private equity people are probably in that category.
Elliot. Paul, does Elliot consider it has a social mission?
Let me state it this way. I think these categories represent, in today's rubric, too stark a dividing line between business and social consciousness or community consciousness. I think in the past it was always the case that most businesses had to and did have obligations, and not just legal obligations, but moral obligations to its community, to its employees, to all of its stakeholders. I think the paradigm of the rapacious corporation, now infused with ESG by a new higher consciousness, I think that's too extreme. I think ESG itself, I mean, there are some good impulses there. Businesses and the way they prioritize their actions and their decisions keep evolving. But I think it's dangerous to say that well, the purpose of a corporation is equally, for all of its stakeholders, because people have to make decisions of location, decisions of strategy, tactics. And by the way, it's having a stultified approach to the location, to the number of employees, to your cost structures, and ignoring the mandate effectively the mandate of globalization. Globalization, regardless of what any political leaders do or say, globalization is here to stay. And there are people around the world that can do your job or my job at 1/5 or 1/10 or 1/50th or 1/100th the cost. And so if a company at the cost of raising wages or keeping from firing people destroys the enterprise, destroys the competitiveness of the enterprise, that doesn't help the social consciousness. So I think these ideas need to and are infusing all parts of the investing and trading landscape, including hedge funds, of course, like ours. But I personally feel that it's a little too stark a delineation, and many of these things are subtle.
Well, thank you. Well, I think I can see from the hands waving that we could go on for another hour. I'm really sorry, but we are out of time. I'm just going to end with one more comment from the BIS, which is this. Do these risks about the economy scream hurricane warning, summer storm, or scattered showers? Quite pertinent given where we're sitting right now. And they say it's hard to tell. I think you've done a very good job of, if not telling us, and giving us a lot to think about. So thank you very much indeed, and best of luck to all of you trying to figure it out.